Hello, everybody. Welcome to Friday Investment Talks with Alan, Mike, and Veronica will be listening in the background to make sure we're not saying anything stupid. Hi, guys. I think I've got some good stuff to go over from Morgan Stanley and Merrill Lynch. We'll go over the put call ratios today, but I know Mike's been following the European markets and reopening of Europe, so why don't we lead off with that, and I'll take it over after that. Thanks.
Well, only to say European reopening seems to be going quite smoothly so far, and it's reflected in strong weeks for indices. The DAX is up solidly, Euro Stoxx 50 is done well. French index CAC 40 has been range bound like the rest of the markets elsewhere in the world, and there seems to be in European markets a link with reality that we've seen detached elsewhere. British markets have not had such a good time, but the chief economist of the Bank of England has come out and declared that he expects a V-shaped recovery. There are three conditions he put on this to make it more of a certainty. One is successful conclusion to Brexit negotiations. Two is a successful settling and increase in the oil price. And three is economic recovery in the UK. But apart from those three things, a V-shaped recovery in the economy in Britain is all but guaranteed. Okay. As we say in English, easy peasy, lemon squeezy.
Fantastic news. Well done.
Mike, is there a date? I mean, as an American, I ask these stupid questions because is there a date for the Brexit negotiations, kind of finalization? I mean, there's been dates and they keep getting moved off.
There have been many dates.
What are we on now? October somewhere?
The real actual exit from the EU took place on, correct me, Alan, but 31st of January back. And
it did, yes.
The UK is in a transition period,
right,
during which most European laws and rules still apply, and there is a cliff edge approaching. The transition period ends on the 31st of March 2021, and if there then is no agreement sort of to smoothly exit the transition, there's effectively back to a no-deal scenario. So there's quite a precipice approaching. There were talks this week, which ended a day earlier than scheduled. So 5 days talks took 4 days and ended with press releases saying there's a lot of ground still to cover, but there was no real detail as to what that ground is.
Okay.
I think that was quite negative as far as I'm aware.
Are you getting lightning, Mike?
Yeah, very close actually.
Mike is jumpy.
I felt the window move beside me.
Okay. Yeah. Okay.
The living in the heart of Europe as I do, I can basically say that a lot of things are returning to. Just noted today that Croatia, so you have to book in advance basically to save time at the border. You basically can email or log into a site and register your passport, register your mobile phone so that they can verify you to save you time at the border, which is a good idea. And they've just said that they passed 1 million people registered to come to Croatia this summer, mostly from Germany, Austria, and Slovenia. So maybe a lot of the continent that is the main part of the continent that can drive to the Mediterranean will actually do so rather than flying.
And I want to kind of bring that into the economic talk about, the markets we're up 4% this week. Not a small amount considering that's only a 4-day week. So we got a real bullish bounce off of the end of June negative kind of pullback we had. And so we published in our blog, and I'm not going to bring it up, but you guys saw in our blog the fact that this first 2 or 3 weeks usually through options expiration, which will be the week after next, is a bullish period for the markets. There was a VIX buy signal that went into play on Monday, and that lasts maybe 21 trading days. So that again, that about 3 or 4 weeks, 4 weeks. So July looks to be kind of set up for a good period here. However, we look forward, we look at the weakest part of the year, August, September, October, and we're kind of more cautious. And I just wanted to show a couple of things that I read over the week. One was from Morgan Stanley, and it kind of is really cool because it shows the S&P 500 and how can it be going up and why is it so positive? Well, most of the index now is weighted in terms of information technology, communications, healthcare, consumer staples, consumer discretionary, utilities, and real estate. The 4 main things it's not weighted in are financials, which are doing poorly, energy, which is doing poorly, materials, which would really need an economic growth, not just a return to normal, but an economic growth, increases in GDP, increases in PMI to start showing up as positive, and large industrial companies. So, and it shows in this graph, the dark blue line is the growth, stability, and defense kind of part of the S&P, which is now at an all-time high as a weight in the S&P versus those other, the financials and the energy and everything else that are at an all-time low in terms of their weighting in the S&P 500. So as we seen before, tech makes up a huge part of the S&P 500. And tech is where the money's going. Tech is where there's no debt on the balance sheets. There's no short interests. There's no dilution in the shareholders through additional stock offerings. And that's where investors are saying those are the safest companies like Microsoft, Google, Facebook, Amazon, the FANG stocks. But other things like even Alibaba this week was up tremendously. Tech companies are where the money's flowing. I just wanted to point out, we talked about this a little bit earlier this week. Earnings reports are coming out probably this week, and starting next week, you're going to get like Intel, some of these big companies come up with their earnings. The banks will come out, and that might lead to some softness, especially as the month wears on, where more and more smaller companies come out and say, hey, we don't have any forward guidance, and the guidance we had for Q2 is totally because we discontinued it in Q1. We had no idea what was going to happen. Here's what actually happened. Things don't look that great. The economy was shut down for portions of the Q2 in the United States too. So I just wanted to go over that, and the fact that they're bullish, and everybody has to be bullish. I mean, you can't say right now you can be bearish on tech stocks and stuff like this. But Morgan Stanley came out with a great note and just said, look, guys, when it comes to the perceived safe haven status of the tech sector, be careful here, because even though interest rates are going to stay low for a long time, you're going to see there's a great expectation for these companies to show great profitability and stay, growing in terms of sales and earnings. And if sales may be growing, but if earnings, like what Amazon came out with and said we were not going to earn anything for the next year because of COVID, we're going to protect our employees and clean our factories and buy clean trucks and everything else, then basically you're going to see earnings either stagnate or fall. These tech stocks are set up for, the price for perfection. So anything less than that could lead to a pullback in later this summer. I just wanted to bring up before like we always do, the put call ratio, and it hasn't rolled over. It's on the computer system that analyzes this says it's on a sell signal, but it hasn't rolled over and started marching higher. And until it does, we don't have a confirmed sell signal, really. We also need the S&P kind of to fall back below levels of support here around 3,000 or 2,950. And even we were talking about before, even if the market does pull back, we don't expect a grand fiasco like we had in March, but maybe a pullback of between 8 and 10%. At which time, as we muddle through low volumes this summer, it would be a good time to start allocating for a year-end rally. And that's basically kind of the prognosis we get from Stock Traders Almanac, from Macmillan, and what we're watching for is really the valuations on the tech companies, and are they going to come in? Is there going to be kind of some guidance during the earnings reporting season? So, Alan, did you want to add any comments or some things that you were going to go on to talk about this week that happened?
No, I think if you want to move on to the
You had
Guggenheim.
yeah, you had that slide from
slides,
Guggenheim, yeah?
I mean, I just find these really interesting, fascinating for such a, it almost looks like socialist type countries. But so what this graph on the left shows is the personal income and personal income without government support, basically. And
Right.
you have almost a mirror image. So the government has really stepped in the US to replace earnings. So much to support the economy, which, as we discussed earlier, it's kind of what they have to do, or there's a kind of a revolution. I think what it and the graph on the right is obviously linked to that, where you can see that it's a spike from something around 15% or 17% recent history. It almost doubled to 34% or something like that, and then it's pulled back a little bit as more jobs are recreated. But it's really old jobs coming back, I suppose.
Right.
What's interesting is there's a debate in Europe in a number of countries, including mine, where people are talking about a universal basic income. So actually paying people to just basically enough so that
To
people
exist.
to
basically exist.
people who don't need to work.
Right.
And a lot of that debate, I don't need to go into it because it's kind of digressing away from the economic part, but it's a lot of it based around mental health, and giving people the reassurance or the stability to plan both personal finances, short term as well as medium term, so that they know they're not going to be evicted. They know that they can actually get enough food and whatever basic substances or basic sustaining goods and products. I thought it was very interesting, and especially in the bastion of capitalism in the US, you have such a big spike in state support.
Right, and I thought this slide from that same presentation was kind of cool because they talked about things that are going to come off here over the course of the summer, right?
So you have or not come off, as the case.
Right, or depending on how politicians decide, right? So we talked about this earlier. You have Trump's election. You have a lot of Republicans in Congress are up for election, and right now it doesn't look good for any of that for those people. So they're going to try to do something to stimulate the economy and bring people back to work. But you have taxes due at the end of July. You have a federal eviction moratorium. What you're talking about in Europe expires on July 24th. So after July 24th, you can actually be evicted now from both commercial property and from residential property if you're not paying your rent, which people haven't been doing.
But is that existing all across the US? Because I read that there was something like 90,000 eviction notices in New York last week. Is that across the US?
I think the eviction notice comes, it gives you certain time to evict. So they're saying, okay, you've got like 2 weeks or whatever.
Or is that only if you rent from the government rather than if you rent from private landlords?
I think a lot of, what happened was I think a lot of states and towns put in their own moratoriums. The federal one is coming off. We'll see what happens with the states and the other ones. Yeah. But the big one here is the federal unemployment benefits. That's what we were talking about in this graph. Was that expires at the end of this month.
The stimulus checks, as they call it.
The stimulus checks of $600 a week, and in addition to your unemployment. So you can see what's really great about this was that incomes actually spiked. There's people with more money now than they had prior to the COVID, right? Yeah. But all of that is because of the government's stimulus checks.
I don't think there was a slide, but I think they also mentioned that the level of personal savings spiked because people got this $600 a month, $600 a week.
Nowhere to spend it.
Nobody was buying new cars because it's too uncertain medium term.
Right.
And no one was going to.
The bars are closed. The clubs are closed. The restaurants are closed.
Right.
I mean, driving around is not possible really. The price of oil went to all-time lows. Right. Yeah, not there's nowhere to go. Campsites were closed. So I mean, some of this stuff is opening up. But my daughter went to a hotel the other weekend. I mean, for the first time. But like, there's nobody there. There's no golf courses open. No restaurants in the hotel is open. So nothing's going on there.
So
But-
the question from that is when the world does open up, is this money going to cascade like a waterfall into the market, into the economy, I should say, at a super velocity?
Mike, we talked about this. I think it was even on one of the Friday talks, maybe not last week, but the week before, where we were talking to a fund manager analyst, and he said that next year is the time where you should be investing in hotels and airlines and hospitality companies, because everyone is going to splurge on a huge holiday next year, because they have the cash. They didn't do it this year. They're going to go next year, and they're going to make sure they have a fantastic holiday. I mean, it's an interesting theory. I'm not sure I buy it, but
it depends on if everything's open next year. From the American point of view, it's like, hey, wait, are we going to be open next year? Or is it going to be a mutation
or allowed to travel outside?
Right.
Because a lot of countries don't want Americans or Brits right now.
Right.
So, all the people who are telling me not to worry about inflation, though, this is the cascade I'm worrying about. These people are telling me not to worry about the inflation are the same people buying, tips and index-linked gilts in the UK.
So we don't have a slide this week, and maybe I can look for it next week. But the amount that the Treasury's balance sheet, maybe we do. We do on our blog. Actually, I want to bring this up. Just give me 1 second. So on the size of the U.S. balance sheet is huge, right? So you do have the potential to reel that in, and therefore that when you reel it in, without even increasing interest rates, you can just start reeling in the money supply, and that itself will actually
temper inflation.
Can temper inflation big time. So
money becomes scarcer. So what happens to equity valuations at that point?
That's why the Federal Reserve needs to see good growth, not just recovery, but actual real growth from where we left off. And that might take years. I mean, unemployment might be high for the next 10 years. That's usually what happens. Now, even if we get a V shape and everybody goes right back to work and there's no fear of virus, there's some damage done to the economy, and that needs to come back. So we do need growth. We need people to go to the hotels. We need people to go on cruises. We need people to take airplane flights like there's no tomorrow to get some of this back. But I wanted to show just real quick one thing about how much money is floating around out there that can be vacuumed up by the Fed. And therefore, you've got to do that before you really see inflation. So you've got to have tight money, and then inflation will happen. You've got to see wage growth that people can say, I got more expendable income, and then inflation will happen. Until then, we're a long way off from inflation. And that's what basically Guggenheim said. The Fed's policy right now is to make tips look good, to talk up the fact that interest rates are not going to go up for a long time, that money will be floating forever in free space. And therefore, this risk of deflation that happens with the recessions goes away. And that's what the Fed is really interested in, is the fact that we cannot have people running around with deflationary fears. And so right on our website, I'm going to bring this back.
I know I keep coming back to the topic repeatedly. I'm not actually trying to advocate that inflation is the logical consequence. I just think we have to keep unpacking how this all unwinds.
Yeah.
And come back to it and come back to it and come back to it, because
you gotta look at two things: money supply, and you gotta look at real wage increases. And right now, within last unemployment report we saw, yes, unemployment went down from 12 to 11.1 or something percent, and 7 million people went back to work over the course of the last month and a half. But the reality is, wages are decreasing. In other words, people are going back, but maybe they're going back part-time. Or maybe they're going back at, hey, we don't have the money to pay you, so you come back without the tips, or whatever you're doing. So I just want to bring this up and then show you right on the website here. We wrote in Russian this, one of our consultants wrote a nice piece about the market and its relationship to the huge amounts of money, a doubling of the balance sheet just in a month and a half. And so all of this money can come back out of the market and make sure that if inflation does start to creep up, you can just cut the money supply. And of course, that will have repercussions for how the economy is going to be doing, how the stock market's going to be doing. But hey, if the economy is doing well and the stock market is booming, then there's plenty of reasons to take these cards off the table. And we can go into that next time about the repercussions for bonds and all that. I think we all know what that means, but like this is enough for today. Yeah, we kind of covered a lot of ground. Yeah. All right. So have a good weekend, guys, and we'll talk next Friday. Thanks.
Look for it.
Okay. Take care. Happy Independence Day.
Yeah.